You're listening to Capital Topics, episode number 85. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we'll discuss with Raymond Kerzerho, PWL senior researcher, about a recent research paper from Morgan Stanley entitled Who's on the Other Side? Enjoy! Good morning, James. How are you today?
I'm very good, François, and yourself?
I'm very good, thank you. Hello, Ray. Welcome back to the podcast. We're pleased to have you with us today.
I'm glad to be here.
Okay, so I'll start. Welcome back to the show. Today we're unpacking a heavy hitter report from Morgan Stanley called Who's on the Other Side? It's all about the tug of war between active and passive investing.
Well, François, this report is really timely. It's really about the current state of capital markets and tries to answer the big questions: are markets still efficient? In other words, has the game changed? We know that passive investing has significantly outperformed active management. Despite that, we read a lot about how active managers are now going to have the upper hand. We also read about how passive is dumb money with investors trading blindly. Finally, we read that the weight of mutual funds that is invested in indexes in the US is over 60% of assets managed. So with all the noise being published, we thought it would be timely to share with our listeners our views on active versus passive. First, I would like to refresh our listeners about our investment philosophy. We are evidence-based and we rely on the science of investing. The evidence continues to be very clear. Passive beats active. Buy, hold, and rebalance is the best option for individual investors. It's more tax efficient. You're more likely to better manage your emotions and stay the course in difficult markets. You're also more likely to actually capture the returns that capital markets offer over time. So it's really timely to talk about this debate of active versus passive. Does it still make sense? So the title of the report, François, though, I would add is very subtle, but it's key to the message. And I often share this with clients. The fundamental notions that markets are not a credit balance in a bank account is very, very important. When you're selling, there's a buyer on the other side. So if you think for a minute, you can ask yourself, what does that buyer know that I don't? And the flip side is also true. If you're buying, then you've got to have a willing seller at a price that makes sense to you. So that is the unique perspective of the authors of this report. Michael Mauboussin and Dan Callahan are really addressing the core concept of who is on the other side of a trade in today's markets. So they highlight there's institutional players, retail investors, sovereign wealth funds, day traders, hedge funds, etc. All these traders trading actively help to make the market efficient to varying degrees.
Yes, Jane, and this is what this makes it a great topic. To make sense of all this, we have invited our colleague Raymond Kerzerho, PWL senior researcher, head of shared services research, to join us today. Raymond, before we get into the meat of the topic, I believe that the authors of the report, Michael Mauboussin and Dan Callahan, those guys carry some serious weight in finance, don't they?
Absolutely. Mauboussin is a titan of behavioral finance and decision science. He works at Morgan Stanley Investment Management. He also is an adjunct professor at Columbia and has written several books on financial decision-making. He and Callahan have worked together for years at firms such as Legg Mason and Credit Suisse.
So I guess, Ray, they're like Batman and Robin of the investment research world, right?
Exactly. They're longtime collaborators, and in this paper, they analyze investment management through the lens of the efficient market theory.
Okay, Ray, can you give us a bird's eye view here of the report and why we are still talking about market efficiency in 2026?
Of course, François, that's a good question. The efficient market theory started in the 1960s with Professor and Nobel Prize laureate Eugene Fama of the University of Chicago.
Yeah, well, we've been very lucky to attend many presentations by Gene Fama. I mean, he's been a longtime collaborator at Dimensional Fund Advisors. He has presented his latest research at the advanced conferences that we attend annually since 2003. Raymond, I think it would be a good idea if you started by clarifying what is meant by market efficiency. I mean, the term confuses a lot of people.
Yeah, absolutely. So coming back to the roots of the concept, Fama broke it into 3 levels. So there's a weak, then there's a semi-strong, and finally a strong form of market efficiency. In the weak form, current prices already reflect all past data. So studying patterns in past stock prices won't help you outperform. Then there's a semi-strong form. In this case, prices reflect all publicly available information, including financial statements, analyst calls, and other disclosure required by regulation. Finally, the strong form holds that prices reflect all available information, including private data.
Well, Ray, when people hear market efficiency, they generally believe that to mean markets are perfectly efficient. But in our experience as portfolio managers over 25 years, we can safely state that the markets are not perfectly efficient. I would also add that Fama agrees. He has been very clear on that over the years. His view is that it's just that it's in your best interest to act as though it's perfectly efficient. And that's what our listeners really need to remember. So in the markets, there are traders of all sorts looking to find pricing inefficiencies all the time. Hedge fund managers, arbitrageurs, again, big institutional players who trade believing that they have an edge to take advantage over other investors. But the reality, again, is the evidence which shows that active managers have not been able to beat passive. François, we addressed this on our podcast number 83 in January when we reviewed market performances for 2025. 2025 was actually a great year where active managers could have beaten the market. I mean, Larry Swedroe wrote about this and we talked about that. He pointed out that 2025 was a prime year for active managers to win because there was so much dispersion, where there's big difference between highs and lows in stocks. So active managers are supposed to buy low and sell high, right? But given a year like 2025, you would think that active managers could exploit that and beat the market, but they didn't.
Well, beating the market is really what most investors care about, isn't it, Ray?
Yeah, exactly. But at the same time, and that's really the main takeaway from the paper, is that you want to beat the market. If you want to beat it, you must have a competitive advantage over other participants.
Yes, and this leads to the title of the report, Who's on the Other Side? Because every time an investor buys a stock, someone else is selling it to them.
Exactly. And if you are better informed than the seller, you're probably getting a bargain. Or conversely, if they know more than you will likely be the one getting ripped off.
Well, a lot of this is based on an investor, be it a retail investor or institutional investor, being able to assess what the fair value is for a stock. But when you really think of it, that requires that you know the future value of the cash flows of a company. And that's not known. It requires forecasting into the future. And then you've got to estimate its value, you've got to discount those cash flows at a discount rate, another assumption. And so what's the appropriate discount rate? Again, it requires forecasting into the future. Active management is selling you the concept that they can predict the future. And we know by the evidence, very few managers can consistently beat the market over the long term.
That's exactly right, James. It's very hard to beat the market. But Ray, how hard is it to actually win this game? What does the paper have to say about this?
Yeah, well, in the game of active management, there should be a winner and a loser, right? And winning is much harder than people think. Over the last century, according to the report, only about 2% of companies created nearly 90% of the total wealth in the market. So it's really tough to pick the right stocks. The odds are very low.
Well, again, Ray, I would highlight for our listeners that we produced a podcast in 2024, number 67, when we discussed the research of Professor Bessenbinder. So really, his research is at the heart of those statistics. His findings are really an eye-opener about how few stocks generate the bulk of capital market returns. And so, again, I recommend to our listeners they go back and listen to it. It's great value. Professor Bessenbinder's fundamental message is that there are very few stocks that generate the bulk of the returns over the long term. The authors of this report are repeating that same message. So active managers must have the skill to find and pick these few stocks that will give them the excess returns needed to beat the market. So given how unlikely this is, it's a big bet to think that active managers are going to win when they're more likely to fail.
Well, the odds of beating the markets and active management are very slim. So if an investor wants to be part of that 2%, what edge does Mauboussin and Callahan say investors need?
Well, François, the authors of the report outline 4 specific categories of advantage. With these categories, the authors provide investors with a self-evaluation grid about their likelihood of being successful active managers. So to be successful, the first type of advantage you need is behavioral. This means that you are more rational, less driven by emotions than other investors. Maybe you're more independent-minded. You're able to resist the urge to follow the crowd when investors are getting overly excited about a trendy stock. Or it may be the opposite. When the market drops like a stone and everybody is in a panic, you are more level-headed and you can identify the moment to buy at bargain prices.
Okay, so that was the first category of advantage. What's the second one, Ray?
The second type is the analytical advantage. For example, you may benefit from buying a security that may not be a great deal in the short run, but you are able to foresee that in the long run, it will perform great. Or maybe you just understand a firm's business model better than most other market participants, resulting in a buying opportunity for you.
And now what about the third advantage, Ray?
Well, François, the third category of advantage is informational, in which in-depth research allows investors to uncover valuable information about complex firms that are not easily available to other investors. And finally, the last type of advantage is technical. It allows you to exploit imbalances between the supply and demand for a security. For example, an investor may excel at studying the short positions in the market, trying to predict which stocks could be hit by a short squeeze when a particular stock shoots up because short sellers panic and buy the stock in a hurry to limit their losses.
Right.
Okay, so Ray, if I summarize what the authors propose in the report, I kind of believe they're trying to make a case that active management can still beat the market, but that's provided they develop an edge over other investors in all these 4 areas at a certain level. And that really means that, it's you got to master a lot of detail and information, and you've got to use that knowledge to trade and beat the person on the other side, be it buying or selling. But it all comes back to forecasting the future, and we don't believe it is possible for anyone to predict the future consistently. So investors who think that they can do it on their own, to me, are really deluding themselves. The evidence that active managers can beat the market is very compelling, and particularly with U.S. equities in the last 15 years when returns were driven by Mag 7 stocks, active managers have professional restrictions on concentrated bets. So right there, they would have rebalanced their portfolios and have had a lesser weight in those stocks. So when the market itself has become concentrated, that's where you really see they can't keep up. And I suspect that is why we are seeing a lot of financial press predicting or suggesting that active managers now are going to outsmart the market as the market shifts away from Mag 7 stocks. So Ray, do you really think retail investors can master all this stuff?
No, of course not. And if I take the view presented by this report, it requires a total mindset shift. You'll stop asking, is this a good company? And instead, you're going to ask different questions, such as, who's on the other side of that trade? Why are they selling right now? What is my specific edge? Is it behavioral, analytical, informational, or technical? What makes me so special?
Yeah, exactly. And if the investor is sitting there and realizes that he doesn't have an edge, whether, like you said, Ray, behavioral, analytical, informational, or technical, he should not be actively trading, correct?
There you go, that's it. The best thing that investors should do is to adopt a passive portfolio to capture the market returns.
Yeah, well, we've covered this many times on our podcast. Don't confuse skill and luck. If you're trying to pick stocks, you may get lucky with your bets. And the same applies to picking an active manager. It's just as difficult to find who's going to be the best active manager and how long that fund is going to outperform. Active managers can be effective for a period of time, but how do you know when the secret sauce is going to stop working? So it's going to work until it doesn't. And then you're back to square one to pick another active manager to beat the market. So this, again, obviously is going to reduce the likelihood you're going to efficiently capture capital market returns over the long term. And again, that's what the evidence suggests. So to me, Ray, I can't see where an investor or an advisor would have an edge at picking active managers. Again, I'm going to get back to what I said earlier in quoting Gene Fama, which is that markets aren't perfectly efficient, but you've got to behave as though they are. And that's really the important lesson that our listeners should take away from today's podcast. By adopting passive management strategies, you're going to give yourself the best possible chance to capture capital market returns.
Yeah, I can concur with that. And I would even add that from a tax perspective, passively managed funds make a lot of sense as well because you won't realize that much capital gains. Since passive funds distribute very little capital gains, they allow investors to defer taxes to whenever they are ready to sell their shares.
Yeah, that's a great point, Ray. I agree with that.
Yeah, well, we actually see that with client portfolios, especially those who've been with us for a long time. If they're not in decumulation mode, they've been adding and saving money. The unrealized gains that they have in their taxable accounts are impressive, especially after 3 recent years of double-digit returns in equities. But what is so powerful is that they are compounding returns in pre-tax dollars in a taxable account. So this tax efficiency, I can't say enough. It's extraordinary. So not only are we efficiently capturing capital market returns, but in taxable accounts, we're deferring capital gains tax for as long as possible. That said, keep in mind, we're for our listeners, we stay disciplined about staying aligned with the client's risk profile and portfolio long-term asset mix.
Yeah, exactly.
Well, we all know that active mutual funds have a disastrous track record. In Canada, at least 97% of active mutual funds fail to beat their benchmark index over 10 years in every category. We have not reviewed the SPIVA report for 2025 yet, but I doubt it will be different from previous years. We will make sure to review it, as well as the active versus passive fund monitor from Morningstar in a future podcast.
So I agree, François. That's always an important topic where we share with our listeners the results of the latest Standard & Poor's SPIVA reports about how well active managers have done relative to indices or benchmarks. And the statistics have been overwhelming in the last few years in favor of passive. So, Ray, based on everything the authors Mauboussin and Callahan are saying, is it fair to make the statement that for retail investors with long-term capital, investing passively continues to be the only real option to be tax efficient and to capture capital market returns?
Yeah, totally. In fact, accepting the notion that markets are, let's say, reasonably efficient doesn't mean they're perfectly efficient. But accepting market efficiency is really a shift in the mindset. It leads an investor to stop wasting energy on trying to predict where the market is going, which stock is going to outperform, or which mutual fund manager is going to outperform. You just stop wasting energy on that and you start to focus on things that you can control.
Ray, how can a financial advisor help investors, or said differently, where can a financial advisor add value for investors?
Well, François, that's really four things that come to mind. First of all, there's the risk assessment part of the work. So we must evaluate how much risk an investor should and can actually handle. Then there's the asset allocation decision, finding the right balance of stocks and bonds. So you want to have enough stocks to generate returns, to generate higher returns actually, but you also want to have bonds as well to provide with downside protection and some stability. So you're looking for the right balance between growth and stability. Then you've got portfolio management. You have to implement the portfolio and rebalance it regularly. Execute the trades to keep it on track with its long-term objectives. Finally, and possibly the most important part of this, is financial planning.
Well, I believe this is the role of every advisor should play. I believe it's a role that we play here at PWL, and that James and the team play with our clients. And this has been at the core of what we've been doing since the foundation of the firm 30 years ago.
Well, gentlemen, I feel this has been a very useful experience, and hopefully our listeners agree. The efficient market concept is very important to our investment philosophy, and it was good to update our research on that. So we know more about where capital markets are today, and what's clear is that it's no easier now to gain an edge over other investors. You would need really extraordinary skill, and that's a rare commodity. And you'd also need very deep resources to do the research that's really going to be required to beat the market. So with all of the various players actively trading in the market, think of big institutions, retail investors, sovereign wealth funds, and many others, the wisdom of crowds will win out over the long term. And, the authors of this report fail to present any evidence that active management will consistently beat the market, and they don't even talk about tax efficiency. So tuning out the noise of the financial press and stick to your long-term investment plan continues to be our mantra. The passive solution with a globally diversified portfolio gives you the highest probability of a successful investing experience.
Yeah, I totally agree with that, James. And on that note, we'll conclude. I think the review of this report brings a new color, a new perspective to active versus passive debate, which is very interesting. So on that, thank you, Ray, for your participation today. I sure learned a lot, and I hope our listeners have found this topic of interest.
My pleasure, François.
Also, thank you, James, for your contribution again today.
My pleasure as usual, François.
So that's it for episode number 85 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our expertise in managing your assets, you can reach us by clicking on the Contact Us button, which is located on the Capital Topics homepage and on all our publications. Furthermore, if you like our podcast, please share with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on April 15th. In the meantime, make sure to consult the Capital Topics website for our latest blog posts. See you soon, and thank you again.